Hi guys, this is Rupali Seth. Now we are going for an NISM Revision Series for Investment Advisor, Module 10. In this audio, we're covering Chapter 8, which is on Assets Allocation and Investment Strategies. Assets Allocation, distribution of investors' wealth between different asset classes. Asset allocation helps in risk management, risk profiling, risk appetite of investors through questionnaire. Equity, gold, debt, real estate are asset classes. Strategic asset allocation. It is based on risk profiling. Risk profiling is the method of assessing risk appetite of an investor through questionnaire. As the age of the investor increases, the depth component in the portfolio also increases. This is a portfolio strategy that involves sticking to a long-term assets allocation. Optimal assets allocation, best strategy to achieve the investor's financial goals, considering all factors like time to goal, value of the financial goal, the investor current and future resources, life stages, wealth stages, dependence, risk appetite, etc. Strategic asset allocation is also known as optimal asset allocation. Tactical asset allocation, tweaking strategy asset allocation based on market condition is known as tactical allocation. An element of prediction of the market's behavior is always involved in tactical allocation. It is a better idea as there is a possibility to exploit various opportunity available if one has the ability to identify and exploit those. An active portfolio management strategy that rebalance the percentage of assets held in various categories in order to take advantage of market pricing anomalies or strong market sector. The major difference between the two is that strategic asset allocation ignores the anomalies in the stock or bond or other market and focuses only on the investor needs. Tactical asset allocation believes that the various markets keep offering opportunities that can be exploited to enhance the portfolio return. Active investment strategy. Fund manager has a flexibility to choose the investment portfolio. Investors expect actively managed funds to perform better than the market. Responsive to changing expectation of the portfolio manager, capitalizing between the portfolio manager belief concerning security, asset class valuation and that of the marketplace. A portfolio manager prediction is based on fundamental and technical analysis. Active investment strategy seeks to maximize the returns by exploiting the ups and downs in the market and buying stock when they drop and selling them when they are overvalued. The strategy aims at higher level of return than the stipulated benchmark. An active investment strategy is adopted with the objective to outperform the benchmark. This requires the portfolio manager to take a decision based on various factors such as the economic growth, the industry outlook, the global market and their correlation with the domestic market, etc. This is generally taken by an expert. Market timing, sector rotation, security selection, investment style, growth and value are the four factors which affect active investment strategy. Growth style. Companies with above average growth rate, high P, high price to book value, low dividend yield are characterized of growth companies. Investing in fully or overvalued companies suitable in a bull market, high risk when compared to value style. Investing in companies below their intrinsic value or which are currently undervalued. Value style is suitable for long-term investments. Low PE ratio, low price to book value, above average growth rate, high dividend yield is feature of value stocks. Low risk when compared to growth style. Value stocks are generally stocks which are out of favor in market. Example: contrarian pick. Passive investment strategy. Fund manager role is limited, low running cost, creating a well diversified portfolio and holding it for a specific period of time. Index fund, ETF are example of passive investment strategy. Buy and hold is an example of passive investment strategy, and a buy and hold strategy is one in which an investor buys a certain assets class or a mix of asset class products and then hold on to the investments. He does not churn the portfolio with the objectives of maximizing returns or minimizing the risk. Time and effort is spent only at the time of portfolio construction. Index fund invest in index stocks as per the weightage. Fund manager has no role in deciding on investment, no designing to outperform the benchmark index. Low running cost performance is a mirror of benchmark index. Tracking error of index funds, index minus index fund return. Low tracking error minus good index fund. Index funds will generally have a beta value close to 1. Why passive strategy? Investors may not have the expertise to time the market. The investor may not be interested in taking higher risk and beating the benchmark with the aim of reducing the transaction cost. Why to rebalance a portfolio? Sell off investment or from overweighted asset category and use the proceeds to purchase investor of underweighted assets category. A review or rebalancing of portfolio is required based on the investment objective of the client. Change in the investment products performance and changing goals, change in the earning and the expense pattern, change in the assets and liability structure of the client makes rebalancing necessary. An overview of different assets classes. Cash or liquid assets generally required for meeting day-to-day and emergency requirements. Bonds are debt securities in which an insurer owes the holders of the security a debt. It is a different term attached to it, include interest and repayment of principal on maturity. Government bonds provide returns which are fixed and backed by central or state government. Those issued by central government are considered to be risk-free as it is believed that a government will not default on its obligations towards its own citizens. Risk and return characteristics of bond are relatively lower than equity and hence suitable for an investor seeking regular income flows with minimal risk. Risk tolerance is about how much risk as a person can take before the same can impact his decision. Some of the external factors which need to be considered for affecting changes in an individual's financial plan are inflation, interest rates, stock markets, regulations, and new products. A stock represents ownership in a company. Volatility is higher in this assets class and cash and bonds as an asset class. Thank you.